Most people assume owning a five-star hotel must be one of the most profitable businesses in the world. A single room can cost $800, $1,500, or even several $1,000s for one night. From the outside, the math seems almost unbelievable. Hundreds of guests arrive every day, expensive cars line the entrance, and luxury brands charge prices that most travelers would never consider paying. It looks like a machine that prints money, but the reality is almost the opposite. Some of the world's most famous luxury hotels generate millions of dollars in revenue every month, while still struggling to produce the kind of profits people imagine. Understanding why reveals that a five-star hotel isn't really in the business of renting rooms. It's operating one of the most complicated economic systems in commercial real estate. The first surprise appears before the hotel even opens. Long before a guest checks into a suite or orders room service, someone has already spent years taking enormous financial risks. Building a genuine five-star hotel isn't like constructing an ordinary apartment building or office tower. Every detail costs more than most people realize. Premium land in a major city can cost hundreds of millions of dollars. Construction requires specialized materials, custom interiors, luxury finishes, advanced engineering, and strict safety standards. Interior designers, architects, consultants, and engineers work together for years before the first reservation is ever accepted. And during that entire construction period, the project earns almost nothing. Money flows out every single day. Interest accumulates on construction loans. Contractors must be paid. Equipment must be purchased. Furniture arrives months before guests do. Every delay becomes another expense. By the time the front doors finally open, the owner may have invested hundreds of millions, or in some landmark properties, well over $1 billion. That sounds like the hardest part. It isn't. Because opening the hotel is actually the moment when an entirely different challenge begins. Because once guests begin arriving, the building transforms from a construction project into a living business. And unlike many businesses, almost every expense continues whether the hotel is full or nearly empty. Think about what has to happen before the first guest wakes up in the morning. Housekeepers have already cleaned rooms. Engineers have inspected elevators, electrical systems, and air conditioning. Landscapers have maintained the gardens. Chefs have prepared breakfast. Security has monitored the property throughout the night. Reception staff, concierge teams, porters, and valet attendants are already at work. Even if only half the rooms are occupied, much of that operation still has to run. This introduces one of the most important ideas in the entire business: fixed costs. A fixed cost is an expense that exists whether you serve one customer or 1,000. A luxury hotel has an enormous number of them. Property taxes don't disappear because bookings fall. Loan payments remain the same. Insurance premiums continue. Maintenance contracts still need to be paid. Lighting, climate control, security systems, and essential staff remain necessary, regardless of how many guests walk through the front door. That's why a hotel can appear busy while quietly losing money. Revenue tells only half the story. Profit depends on what remains after every operating expense, financing cost, and maintenance bill has been paid. Two hotels charging the same room rate can produce completely different financial results simply because one controls its costs more effectively or carries less debt. But even that explanation leaves out something bigger. Most people believe the guest room is the center of the hotel business. Economically, it often isn't. A five-star hotel is better understood as several businesses sharing the same address. There are guest rooms, of course, but there are also restaurants, bars, banquet halls, conference facilities, spas, fitness centers, retail boutiques, parking operations, laundry services, and sometimes luxury residences attached to the property. Each has its own costs, employees, and customers. Some generate healthy profits. Others exist for a different reason entirely. And that's where the economics become surprisingly counterintuitive. Not every department is expected to make money on its own. Some are designed to increase the value of everything else. Consider the hotel's signature restaurant. It might serve exceptional food, employ award-winning chefs, and receive international recognition. Yet in some luxury hotels, the restaurant's direct profit margin is modest, or during certain periods, it may even operate at a loss. At first, that sounds like poor business, but the restaurant isn't just selling meals. It's attracting affluent guests, enhancing the hotel's reputation, increasing media attention, hosting business meetings, and giving travelers another reason to choose that property over a competitor. A memorable dining experience can influence someone to book a room, recommend the hotel, or return for another stay months later. The restaurant may not maximize its own profits. It may maximize the hotel's overall value. And once you understand that idea, the rest of the luxury hotel business starts to look completely different. A five-star hotel is constantly balancing one difficult question. Should it try to fill every room? Or should it protect its image by charging higher prices and accepting fewer guests? Most businesses would choose the first option without hesitation. Selling every available product sounds like the obvious path to higher profits. Luxury hotels often think differently. Imagine a hotel with 300 rooms. During a slow season, management could cut prices dramatically and fill almost every room. Occupancy would look impressive. Guests would see a busy lobby. Investors might notice that nearly every room was occupied. But something else would quietly happen. The hotel's average room rate would fall. And recovering from that decline is much harder than most people expect. Luxury hotels don't just sell a place to sleep. They sell exclusivity. If guests become accustomed to paying $400 per night instead of $900, convincing them to pay premium prices again can take years. Frequent discounts can also weaken the perception of the brand itself. A hotel that always appears on sale gradually stops feeling exclusive. This is why hotel executives pay close attention to a measurement called RevPAR, short for revenue per available room. The name sounds technical, but the concept is simple. Instead of asking how many rooms did we sell, RevPAR asks a more important question. How much revenue did every room in the building generate, whether it was occupied or not? That changes the conversation completely. A hotel charging higher rates with slightly lower occupancy can sometimes outperform a completely full hotel charging discounted prices. The building may look quieter. The business may actually be healthier. This creates one of the industry's most surprising contradictions. An empty luxury suite isn't always a failure. Sometimes it's a deliberate decision. That illustrates one of the biggest misconceptions in the luxury hotel industry. The busiest hotel is not always the most profitable one. At this point, you might assume the person who owns the building also runs the hotel. Sometimes that's true, but many of the world's most famous luxury hotels operate very differently. And understanding that separation explains almost everything about the modern luxury hotel business. Many travelers believe Marriott, Hilton, Four Seasons, or Mandarin Oriental own every hotel that carries their name. In reality, that is often not the case. In many cases, the owner is a pension fund, insurance company, sovereign wealth fund, private investment firm, or wealthy real estate investor. They provide the capital to buy the land, finance construction, and own the property. But they may hire Marriott, Hilton, Four Seasons, or another luxury operator to actually run the hotel. That arrangement may seem unusual, but economically, it solves several major problems at once. The owner benefits from professional operations without building that expertise internally. The management company expands its global brand without investing billions of dollars into every building. The guests receive a consistent luxury experience they already recognize and trust. Everyone specializes, and specialization usually creates a more efficient business. That model also explains why reputation has extraordinary economic value. A trusted luxury brand can often charge significantly higher prices than an unknown hotel offering a similar physical building. Guests are paying for more than marble floors and comfortable beds. They're paying for confidence. They expect the room to be clean. They expect the service to be exceptional. They expect problems to be solved immediately. They expect consistency. Meeting those expectations every single day is what the brand is really selling. Then an event arrives that exposes how fragile the entire business can become. The COVID-19 pandemic became the industry's biggest stress test in modern history. International travel collapsed almost overnight. Business conferences were canceled. Weddings disappeared. Luxury tourism nearly stopped. Revenue fell dramatically, but many of the largest expenses remained. Some owners negotiated with lenders. Others delayed renovation projects. Many reduced staffing where possible. Management companies introduced stricter cost controls while trying to protect service quality. Hotels that survived weren't necessarily the most luxurious. They were often the ones with stronger balance sheets, better financing, flexible operations, and enough liquidity to survive months of weak demand. That crisis demonstrated something investors had always known, but many travelers never noticed. A luxury hotel is not simply a beautiful building. It's a financial system wrapped inside an unforgettable guest experience. Every decision affects dozens of connected parts. A pricing change influences occupancy. Occupancy affects staffing. Staffing influences service. Service shapes reputation. Reputation determines pricing power, and pricing power affects the owner's ability to repay debt and earn returns. One small decision can travel through the entire system. That is why experienced hotel investors rarely focus on one number alone. They analyze the entire ecosystem. Now, consider the ultimate question. Is owning a 5-star hotel a good investment? The answer depends entirely on the circumstances. A well-located property with strong management, reasonable financing, and a trusted global brand can generate attractive long-term returns. A similar building with excessive debt, poor management, or weak demand can struggle for years. The difference is rarely the building itself. It's the economics behind it. So the next time you walk into a grand hotel lobby with marble floors, polished chandeliers, and impeccably dressed staff, remember that you're looking at only the visible layer. Beneath that polished surface is a business balancing debt, labor, pricing, reputation, investment, and risk every single day. In the end, a 5-star hotel is not really selling rooms. It's selling trust. And everything else